Rob, I am going to make you the host.
All right.
You can take it away.
All right. Welcome, guys. Thank you guys for coming. So I'm going to share my screen with you to get going. So, all right. All right. So yeah. Yeah, so here's kind of our agenda for the night. So it's just kind of this is an introduction to real estate investing, kind of understanding the market, the financial prep, kind of how to select the property, some of the legal and tax considerations, strategies, and then some of the risk and reinvestment strategies, and the kind of the next step to take. So throughout here, though, we do have some polls. So if you have your phone or if you're on a computer, if you got your phone, you just scan the QR code. Otherwise, you can just quick jump onto a web browser, put in slido.com, and then there's that number 4513425. You can put that in and our polls will pop up. So the first one we have is true or false. You need to be wealthy to start investing in real estate. So these are going to be, it's a live poll. So as you guys kind of click on them, we can get going through it and see what happens. So what do we see? We got two so far. Saying false. Just give it a couple seconds. All right. Yeah, you guys are correct. There are different ways, to purchase property. You can start, just by starting off by starting small. You don't need to have like $100,000 out of pocket. It's kind of one of those things that, even that first home that you purchase, that is a real estate investment. So, but a lot of times when we talk real estate investment, we're thinking, though, not our traditional home. We're thinking something that is going to generate income, some long-term wealth, get some rent coming into our pocket. So there really are three ways to make money in real estate. So the first one is rental income. And that's the one kind of everyone kind of thinks about. It is when you purchase a home, you find your tenant in there, you get them in, you start collecting that rent check. So there's the rental income side. But on top of that, even while you're collecting that and on your primary residence, you have appreciation. So over time, it is seen that real estate it appreciates in value. So you can see a profit down the line. You might buy a house or a rental property, so say for $200,000. 10 years, you could sell that for $270,000. So now you just made $70,000 in appreciation. So that can be, like I said before, it's on your primary residence. That can be on a rental that you get. So it's just kind of an additional way that it's not something that you're putting money in your pocket, but down the road, you're seeing that those gains come out. And then the last one is house flipping. We see a lot of these on reality TV shows. You see house flippers, you see different stuff. People are buying a distressed property or something that needs work. They're putting some money into it and then selling it for a higher price. So those are really the three ways that you can make money in real estate. Now, the benefits of real estate investing. So, because a lot of people are like, should I invest in real estate? Should I invest in stocks? Like, where should I put my the money that I have to invest? So one of it is it's a passive and stable income. So if you buy something and you have a tenant in there, for the most part, you know what you are getting each month. So if that rent check is $1,500 a month, you are having a pretty steady income with $1,500 a month. Unlike stocks where, you might one year make 5%, one year you might lose 13, hopefully, or you might gain 15 one year. So you're not 100% sure with real estate. It is something that once we get that tenant in there, we can see that they are actually paying us. We see that. There's tax advantages to real estate. There's a number of tax benefits such as deductions for depreciation, mortgage interest. We're going to kind of touch on this in a little bit and we'll kind of get deeper into it. And there's also the benefit that I've always said is with real estate. It could be vacant land. It could be a house. That it's a tangible asset, that it's something that it can't go away. Like if you invest in stocks, you invest in a business, that business can fold, that stock can go away. If you have a house, you have insurance on it, for the most part, that is something that is there. Nobody can come and just claim that from you and just take it. So those are kind of the benefits of real estate. And it's kind of the introduction of why to get into real estate investing. So, and then one of the things when you start is understanding the market. So that means, determine your target area. Like, do you want rentals? If you live in the state of Michigan, do you want them 15 miles around you? Do you want to be on the other side of the state? So kind of that idea of where you want to be, what your clientele kind of is that you're going for. So those are kind of things to start looking at to see, what is your target area? One of the things to consider is up and coming neighborhoods, growing economies, and school districts. So if you have, you're looking for, you get in a house that's a 3-bedroom house, 2-bath, you're trying to get that family in there. I mean, if you're going to buy something that's out, in the country, you're probably going to have a hard time finding a family to rent that if there's not a school close by. So it's kind of different things to consider when you are looking at what piece of property or kind of what you're looking at purchasing. So if you're purchasing local, we recommend driving around. If I have a neighborhood that you like drive, see what kind of parks there are in the area, see what kind of grocery stores are around, see what the conditions of the house around you are. So, you get into something that, the neighborhood might be a little sketchy, that maybe isn't an ideal location for you if that's what you're determined your target area is. So there's all things to consider when you're kind of jumping into the real estate investing side. And then also research your local rental rates. So kind of a rule of thumb that people use is whatever the value of your home is, it should be 0.8% to 1.1% of the property value. That's not that that's going to be always what it is, but it's kind of just an idea to start. So if you buy, let's just say a 4-plex that you pay $350,000 for, that 4-plex should hopefully generate about $3,500 a month is kind of what you're looking at. So that's kind of gives you a good starting point. But also, you can jump online, look at stuff. Ask around, find different investors, say, hey, what are you getting for rent? If you know somebody, just kind of see what that rental in that area is. So you don't want to buy a $300,000 house in an area where rent is only like $1,200 to $1,500. So that's going to be, you're not going to be able to probably, cover your investment costs. You're probably going behind then on the rental side of it. So one way to do some of this stuff is connect with local trusted real estate professionals. They know the area. You can talk to them. They can look in comparable sales in the area. They can tell you, okay, here's what this house is going to sell for in this market. And then you can kind of determine, okay, is that matching up with the local rental rates to see, is this a good investment? Is this, something that I can turn a profit on or start at least break even on, type of thing. So, and then that's where we kind of come into from the mortgage lending side is we can determine then and say, okay, the financial side of it, does this make sense for you? Like we can analyze all your income for you. We can analyze what the projected rent is going to be. Especially if you find a place that has income in it, we can use part of that then as to qualify you on the income. Then once we get that, we can look at everything, get you that pre-qualification letter, and hopefully you guys start purchasing something soon. So another poll that we have as we're moving on, can you purchase a multi-unit property as a primary residence? So that's our second one. Give it just a little bit and see what happens. I know one guy here, this is kind of a cheating question for him. 100%, 5 participants. Nice. All right. Yeah, so the financial corporation, with that, you can purchase a multi-unit property as a primary investment. So it's kind of a pro tip. But we'll kind of get into that a little bit. We just kind of wanted to throw that poll in there to see where you guys are at. So one of the things to look at is the rental income. So a lot of people are like, okay, I'm pulling $2,000 a month out of this. So I'm making $24,000 a year. So that's what I'm going to put in my pocket. You still have though, you start taking your mortgage payment into that. You start taking your property taxes into that. And with your property taxes on investment property, if this is not your primary residence, it is not going to be homesteaded. So it is going to be higher property taxes than normal. You're going to have your insurance, which now you have renters in there. So your insurance is probably going to be a little bit higher. Maintenance and repairs, time of vacancy, property management fees if you decide to. Those are all fees you have to start looking at that, I'm pulling in $24,000 a year on this rental, but what are some of the costs out of that? So that's stuff to look at. And that's kind of what we can do. We can help you out with that. We can start kind of playing with those numbers. There's definitely things to keep into consideration. So on the financial side of it, to purchase it, when you talk to us, how much do you need for down payment? So on a 1 unit investment property, it would be about 15% down. Is actually, I mean, 15% down or beyond. But if it's a 2 to 4 unit, you are looking at 25% down that have to come out of pocket. So when if you're looking at a house, those are definitely like calculations to start looking into. If you're looking at 1 to 2 to 4 units with what you have as income or as money to put down. So the tip that we had with this is if you purchase a 2 to 4 unit and live in one side, that is how you can use the primary residence. Then you can get into it for only 5% down. So that's something to consider. If you want to start off and like, hey, you know what? I got a 4 unit that I can rent each side for $1,000, but I'm going to live in one. You can put only 5% down to jump into that unit, collect that $3,000 worth of rent, and still, qualify as a primary residence. Closing costs on that, though, you're going to want to plan for 10,000 plus for closing costs and setting up your escrow account. So on those, because rates are definitely higher on if you're purchasing it as investment property for 1 unit to 2 to 4 units. So there's definitely going to be a cost out of pocket for that. So property selection. So are you looking for investment property? You got to pay attention to the condition of the home and the potential improvements. It's one of the big things I think some people go into when they are looking at investment property is the condition of the home. I was just talking to a guy who was purchasing something and he waived inspections. It was a single house. Ended up being that the roof needed replacement in 2 years. So all of a sudden you're thinking you're collecting X amount in rent, but now you have a $10,000 repair that you have to put in. So I do recommend that if you are looking at for investment property to just spend the $400 and get an inspection to see where it's at. Pay attention to the condition of the home. Know what you're going to have to put into it, because you can get stuck. You see some of these flipping shows where they buy something and they start digging into them and they get stuck with large bills replacing, the septic, replacing the plumbing, the electrical is bad. So it's all different things to look into and to start considering. So again, we recommend hiring then a real estate agent. They can provide a lot of valuable insight. They have been through a lot of things. They can recommend great home inspectors. So you know what repairs have to be made before you jump into that rental. So the legal and the tax considerations that we talked about, we're looking at. So educate yourself and seek legal advice because we are not attorneys. Real estate, they're not, or agents, they are not attorneys. So look at fair housing laws because the tenants must be selected without regard to race, color, religion, national origin, sex, familial status, and disability. So some of this is the kind of stuff that you start as you're looking at investing that you kind of start forgetting about. That as you're looking at tenants, that there's different laws that you have to abide by. Landlord tenant laws. I would familiar yourself with those on the local laws concerning, who can live there, standards, security deposit limits, eviction procedures, tenant rights. So one of the things now, a lot of people are talking about short-term rentals. A lot of areas are eliminating short-term rentals or talking about it. One of the places I know, like Marco Island down in Florida, it's a great area for short-term rentals, but they are pushing really hard, the local residents are, to get rid of short-term. So that's all different things to start looking into, what's going on, what laws there are as you are considering the investment property. And then the lease agreement. It is a well-written lease agreement is vital. This is where a lot of people can get in trouble, is by having, I found it online. It looked good to me. So we really recommend when you have a lease agreement, have an attorney look at it. Make sure, both parties are happy, because it is crucial to have that so that, hopefully if something does pop up, you have it in writing. And it's not a he said, she said. It's not a, well, I assumed this, well, I assumed that type of thing. Because if it's written out and when you give it to your productive tenant, ask them, hey, make sure you read this. Did your attorney read it type of thing if you want to. So it's just different things you can kind of protect yourself on. So then the tax benefits. of investing. So many of the costs of rental properties are deductible. So when you are collecting your rent, you have your expenses, but then also you can deduct the mortgage interest. You can deduct your property taxes and insurance. You can deduct your operating expenses, the repairs and maintenance, and your depreciation of the building. And the depreciation, it's about 27 and a half years, at about 3.6% per year is what they can depreciate on your taxes. So those are kind of some of the benefits of having it. So one of our last polls, we're moving on. We're going through this nice and quick so you guys have time for questions. Is there a way to defer capital gains taxes, which is the taxes on the appreciated value of the real estate? So if you buy something for $200,000 and you sell it for $270,000, is there a way to avoid paying taxes on that $70,000 of capital gains? 1, 2, 3. All right. And you guys are correct. So there is a way to avoid that. It's called the 1031 exchange. So what that is if you buy something for 200,000, you sell it for 270, you can take that money, you have a time frame to flip it into a like-kind property. So let's say now you find something for 275,000, because it's got higher rent. You can flip that into that house and not pay the capital gains on that. It's a way to keep kind of increasing your portfolio and the size, what you have without paying it to Uncle Sam. So it's a good legal way to do it. What we do with that, we recommend is, talk to a real estate professional. They know a lot of those. We know a little bit. Talk to your accountant about it too. So there's a lot of people out there that can give you advice on it, but it's just a good strategy. And remember, 1031 exchange is the way to avoid those. So once you own the property, you have to have a property management strategy. So you have to consider the pros and cons of self-management versus hiring management companies. So that was some of the stuff I know that I ran into different times. Is I would get calls, at 10:30 at night. Hey, my AC unit isn't working. Like, what's wrong? Or, hey, my furnace isn't shutting down. It's smoking. Now you have to, if you're running it yourself, you have to take care of it. So you're running over there, or you have a tenant that says, hey, my toilet's overflowing. It is Super Bowl Sunday. You're watching the game and they have water dripping out of their toilet. So you can't just tell them, hey, I'll deal with it in 2 hours for you. So that's kind of what you start looking at is, are you going to be doing it yourself? Or are you going to hire someone to do that? So that's some of the costs now that you have to look into. If you're hiring someone, the side of the property management, that's part of it's going to be eating into your expenses. So it's kind of what you guys decide to do. And then it's also how you're going to handle the tenant screening, rent collection, property maintenance issues, kind of we talked about, because a lot of the property managers will do this for you. So they'll collect the rent. They, like I said, they'll take care of the property for you. If there's a tenant issue, they can help handle that. I think a lot of times as a first-time investor, you're starting off maybe with that $200,000 investment property, you'll handle it a lot yourself. And it's also something to look at as the size of your portfolio. That, if it's one house or one unit, it might be you bought a duplex and the tenant lives right next door, so it's no issue whatsoever for you to walk next door if there's a problem. But now you start getting into 10, 12, 20 units as you start building that portfolio. Is that something you want to be responsible for? So now you might have extra income coming in between that allows you to pay for that property management service. Someone else to kind of handle it. You are the one that kind of, hey, I just get to collect these rent checks. So just call the different things to consider. But yeah, then there's also to consider is the risk that is involved in real estate. Because there definitely is still risks in it. So as with any investment, there are risks involved. So property damage. So you have to consider the insurance coverage. So talk with your insurance agent to make sure that the property is properly protected. And a lot of it too is, if you have a tenant in there and they trip, do you have the correct insurance so if they sue you? Type of thing. So it's not just strictly, insurance for if someone kicks a hole in the wall or if a tree falls through the roof. type of thing. So there's more than just that side of it. Um, Vacancies. So you create a separate savings account is what is recommended to prepare for times of vacancy. So on average, you might have a great year where you have, the tenants that are in there, you have a 12-month lease, you've collected it, now they vacate, and it takes you 2-3 months to find someone to rent that space. So now, do you have money to cover that mortgage payment? Do you have money if you have a property management company to pay that property management company? Because they are still going to be mowing the lawn. They are still going to be paying, making sure all the taxes are taken care of. So those are kind of things to kind of start budgeting for, start thinking about as you start building up your portfolio. So, and some of the other risks we'll throw into there too is with the maintenance costs. Like I said, there's roofs. I manage a commercial property, and we right now are looking at having to redo the roofs, and we're looking at $120,000 expense. So when you do buy something, and if you see that, this roof is 10 years old, the shingles average roof is 2025, in 10 years that roof is going to need replacing. So now you're like, okay, that's going to be about $12,000, $10,000. So I would start setting aside, $1,000 a year to start paying for some of these expenses that are going to be coming up, if that's something you're going to hold on to. So there's just different ways you just kind of constantly be looking at, what could this cost me? What could be coming up? Because kind of that rainy day fund. So in your reinvestment strategies, you can consult your local trusted loan officer if you're thinking of refinancing or purchasing other investment property. Because once you do have an investment property, you might be able to use the equity out of that to buy something else. So now you have the rental income out of one property that's paying you, let's just say you bought a duplex, you're living in one side, the other side's renting for $1,500. You have an extra income of $1,500 coming in. So that's something you can say, now can I use that to leverage my debt to income to buy something else, to buy another income producing property. So it's kind of the different things that we can look at, help you guys do, is kind of look at your finances, look at what rental income you have, and kind of help you build that portfolio. So we kind of touched on this already. When you sell the rental property, to look at doing the 1031 exchange. So otherwise you are going to be paying capital gains on the difference between your purchase price and the sold price. So yeah, so your next step, guys, is kind of the basics of jumping into real estate investing. There's a lot of benefits to it. We're going to dig in a little bit deeper next week on the actual budgeting for investment property, the actual costs, kind of a little bit more. And then we talk to you guys, contact us, your local officer or loan officers at Michigan Mortgage. We can help you guys answer any questions on this kind of stuff. That's just kind of a general stuff to look at when you're starting to kind of look at, do I want to jump into it? Do I want to be a landlord? Do I want to start building that portfolio for future wealth? So yeah, we're going to open it up to questions right now.
Yes, thanks so much, Rob. So
yeah,
one thing I do want to clarify, it was a question we got in the chat earlier. Yes, we are recording, and we will share the link after the webinar, likely tomorrow morning. So that will give you another opportunity to ask questions if you didn't get a chance to ask them tonight. But the floor is open, so feel free to unmute yourself or use the chat feature, and we can answer any questions that you may have.
I just want to say great job, Rob.
Thank you.
I just an example. I bought a house one time for $70,000. The renter paid me for 10 years, so basically paid my mortgage off. 10 years later, I sold it for $180,000, and plus the 10 years that she paid my mortgage. So there's definitely long-term 401k thinking in this system, which is a great investment system. So that is a good thing, but you hit on the important parts. Make sure you have the insurance, because you have to have the fire extinguishers. You got to have the right renter insurance. You got to have the right contract. But if you do the right steps, you will make a profit. Real estate is proven over and over again that you can make money in right investments.
Yeah. On average, real estate appreciates in value 3 to 5 years, or 3 to 5% per year. So, and there are years that are 10, 12. But for the most part, real estate, I think since 2008, there's only been 1 year that real estate depreciated, I believe. I mean, correct me if I'm wrong, but
2008 was pretty rough, but
yeah, and a lot of no, I mean, there's portfolios that I've handled. I mean, for retired guys, that literally is what their income is. That, you know, they were self-employed, didn't have 401k. They put it into real estate. So now everything is paid off, and they are collecting, you know, over $15,000 a month in rent as their retirement. I mean, plus that.
Anybody else have questions?
Is Rob? Rob, are you trying to say something?
I know I sent him a chat and said, hey, Rob, I see your lips moving, but I can't hear you. So Rob, if you if it's short and sweet, you can use the chat box. But if not, we're having a hard time hearing you. I think he's typing something for us.
Denise, do you have anything?
No, I don't. It took me a minute to unmute myself. Sorry.
Or Frank or Tommy?
Yes. And Rob, the other Rob's chat just came through, and he said for 1031 exchanges, it defers the capital gains taxes, but it does not eliminate it.
Yes, correct. Yeah. As long as you keep moving it, though, you'll never have to pay it, as long as you don't sell it, though.
Mm-hmm.
So just die before you get rid of it.
Yes, absolutely. And Frank said, thanks so much for hosting. Frank, we're so glad you were able to join us. If you have any more questions, we'll make sure that you have our contact information so you can get in touch with us. But I don't think I'm not seeing any other questions come in.
Okay.
So Rob, unless you have anything else you wanted to add, I think we can.
No, I just hope you guys, just come next week. It's going to be a
Yes.
deeper dive in the actual budgeting of the investment property. Rob's going to be presenting on that one. So
yes, yep. And we'll send out that information via email. You can also find the registration link on our Facebook page. And then week 3, Dave Lehner and his team is going to talk all about credit and what kind of credit scores you need and how you can go about building credit. So you can really get started and hit the ground running. So thank you all again for being here, and be on the lookout for an email from us with a recording.
Yeah. Thank you.
Thank
you, guys.